Despite not being a part of the European Union, today's disappointing GDP figures suggest simply being surrounded by floundering Eurozone economies is starting to take its toll on the Swiss economy. Valentin Marinov joins me down the line to discuss. Valentin, some economists were surprised by the magnitude of the weakness in the Swiss economy, which has so far sidestepped the problems caused by the crisis in Ukraine and stagnation in other parts of the world. But what was your reaction?
Yeah, we were also surprised. We were looking for a small increase in the second quarter following the impressive growth gains in the first quarter. So the flat reading was indeed a surprise. And it highlights the fact that whereas Switzerland has long resisted sanctions on Russia, or indeed any involvement in that standoff between Russia and the West, its close ties to Europe's growth engine, Germany, and other EU economies are having an impact. So given that these are important trading partners and part of that trade is then linked to Russia, is clearly having an impact. A second venue really here that is could explain the outcome is the fact that deteriorating sentiment in Switzerland's main trading partners is weighing on their investment, employment decision, and as a result, that's also affecting the Swiss producers and the Swiss economy.
The crisis helped push the Swiss franc to its highest level versus the euro since December 2012. Friday sees the SNB's FX reserves, which will also be highly scrutinised. But is the cap now hindering the Swiss economy? Should the SNB step back into the market?
Well, I think what is potentially more likely is for the SNB to respond to persistent Swiss franc appreciation by adopting somewhat different measures. In particular, we think that negative deposit rates by the SNB may be more likely than outright interventions. In this regard, we're highlighting that FX reserves have grown to quite a considerable amount, close to 19% of GDP. And from that point of view, the risks, the costs associated with FX reserve management have grown tremendously. So in that case, I guess the SNB may have little choice but to look for alternative measures to lean against sustained Swiss franc appreciation.
Indeed, the data comes ahead of a quarterly SNP meeting on September 18th. With interest rates already near zero and that 3-year-old cap on the Swiss franc still in place, analysts say there is little the central bank will be able to do to reinvigorate growth. What is the market hoping here for, though?
Yeah, we are looking for quite a sober assessment of the economic outlook for Switzerland. The latest data is a case in point. Switzerland cannot be possibly hoping to decouple, and by implication, the SNB cannot be hoping that the Swiss economy could decouple from the slowdown in the Eurozone, in the EU. Needless to say, further escalation or persistent tensions between Russia and the West could only add to the cyclical headwinds for Europe, for the European economy, including Switzerland as a whole. That should be then reflected in a more cautious assessment, potentially downward revision of the growth forecast by the SNB, not only for this year, next year as well. And I guess more importantly here, a revision for the inflation forecast. Importantly, the SNB has largely ignored the return of inflation last year. They actually lowered the inflation projections, partly on the back of renewed Swiss franc appreciation. I guess more of the same may be expected going into the meeting on September 18th. I would further argue that should indeed Euro-Swiss weakness persist, so that if the floor is to be tested, that will increase SNB's resolve to add more measures. And as I said, I think negative deposit rates could be next.
Valentin, great to speak with you. Thank you for your insights. Well, viewers, for more currency outlooks, make sure you click back for the midweek edition of Forecast tomorrow with Darren McDermott. For me, and for now though, it's goodbye.